Hi. Yesterday's Fed decision was predicted by many to be a no-show, with only a minority expecting tapering to begin in January. Thankfully for the markets, the wait is over. Tapering will begin in the first month of the new year. However, as 2013 reaches its climax, central banks, post-financial crisis of course, become a key focus for market players, as they often hold their last rate decision of the year around this time. The ECB is no different, and with 2014 just round the corner, some analysts believe very soon we will see more easing. Joining me on the line is Peter Frank, FX strategist and G10 currencies specialist at BBVA in London. Peter, thanks for joining me today. An analyst told me recently he thinks the ECB will have to find the economic justification to push more easing very soon. Do you agree with this statement?
It's going to be a very mixed year, I think, for the ECB and for the Eurozone. Certainly in the short, I think the justification for the easing that we had at the end of this year is quite obvious. There's lots of output gap closure that's required pretty much across the EMU in order to stop any form of disinflation tipping in towards something more serious. So I think they don't need much to justify that. The growth rates that we're seeing remain very mild, even in the strongest economies such as Germany. But what our view is that certainly the EMU is repairing, but the idea for us is definitely there is a risk of further monetary stimulus from the ECB. Whether or not that's a deposit rate cut, well, that's a different matter. That would be more of an emergency rate decision. More likely, some kind of extra liquidity provision is going to be needed just to nudge the economy into a faster growth rate across the EMU. So we would generally disagree with that statement from those analysts.
Okay, if this is the case, where do you expect, say, euro-dollar to be in a few weeks' time? Because at the moment, it's going nowhere, really.
Well, euro-dollar's held up reasonably well despite the tapering announcement that we had yesterday. I think a part of that is because from the dollar side, there's still the big dovish caveats there in place that the Fed outlined. They're still worried about inflation being too low. The Fed has got that as one key caveat for when they're going to start to withdraw the accommodation on rates, possibly more than 2 years from now. They're still worried as well about the global growth picture, and of course they continue to fear that if there was a big pickup in yields, as we started to see earlier in this year, that could slow down the housing market and reverse all the significant gains and improvements seen in the rebalanced U.S. housing market over recent years. So that they are still quite cautious, and that's helping the euro to hold relatively firmly against the dollar. But our view is really unchanged, to be honest. We've had this view that we'll get euro-dollar down to around 134, 135 by early 2014, and then it's going to start to slip lower to the first half of the year, probably hitting around 127, we think, during the summer, which is probably the cyclical trough. So we are bullish dollar in the short to medium term, and certainly the first half of next year we think will be more bullish for the dollar because of the growth cycle being that much more ebullient than what we're seeing in the Eurozone, which is a much more gradual and tentative recovery.
Okay, we've touched on currencies a little and the euro. Let's take a look at European stocks, because like the US, indices are expected to continue to rise next year as the economic recovery picks up speed. Is it plain sailing for global stock markets from here on in, or do you foresee any problems going forward?
Our view on the stock market is generally globally quite bullish. We're certainly constructive towards G10 economy stock markets. We are actually increasingly optimistic that there is more value to be had as a leading indicator to invest in broader EMU stocks than, say, US stocks. Now, that seems a bit strange in a way because we're very optimistic about the US growth cycle. We think the US growth cycle is already peaking out fairly quickly. The productivity has remained very strong in the US, but we think that we are going to see a trend fading in productivity growth in the US because of the cyclical nature of productivity. And we think actually that we're seeing some very strong positive signals in productivity across the EMU, with countries like Spain leading actually that improvement. And we think that means that if you're looking at margins and things in broader large companies in the EMU, you could see significant upward moves in profits in the year ahead. And if you look at the stock markets, you've got record levels in the S&P and the Dow Jones in the latter stages of 2013. But yet, if you look at the European aggregate for EMU stocks, we're pretty much about half of the record value. So there's a significant gap which we think will be filled as long as you get a productivity-led recovery in the EMU. The problem with that is you might not see the real kick-up in stock prices until later on in the year, and that will probably coincide with a much stronger euro against the dollar during the second half of the year as well. And we actually have a forecast that whilst euro-dollar will dip down in the first half, we do expect it to spring back and start a broad multi-year recovery. And stock flows, equity flows, M&A flows, also FDI flows, we think could be a key driver of a stronger euro against the dollar during the second half of the year. And that's probably closely linked to the fact that the stock markets are much more undervalued and therefore good value for the longer term in EMU than they are in the US. So we're actually optimistic, certainly in the second half of the year, for EMU stocks to outperform.
Okay, that's all we've got time for right now on the ECB, but we've got UK retail and New Zealand GDP figures all being covered today by my colleagues here at Dukascopy TV, so do check those out. I'll see you on Monday though for the press review. Until then, bye-bye.